All right, hello everybody. Welcome to another Revolution Realty Team live stream. We have Travis, not Tyler. I'm going to make that mistake today. I know that I am. Travis with Ohnward Bank with us. Travis, how are you?
Good. I've been called worse too, so don't worry about it.
I was joking with him. I have an older brother named Travis, and so maybe that's why I'm mentally blocking the name out from all the childhood trauma of an older brother that was 7 years older than I was. So, no, Travis with Ohnward Bank. Tell us a little bit about yourself. And I know we had caught up a couple of weeks ago about you kind of just moving into the area, or back to the area rather. Why don't you go give people a little bit about your background and kind of what you do, and then also what you do at Ohnward.
Yeah. So I'm a mortgage manager. I've been in mortgage my whole career, close to 15 years. Grew up in Marion. God bless Marion, Iowa. Moved away after college at Mount Mercy to Des Moines for 10 years. And great time there cutting my teeth. We talked about cutting your teeth in a corporate type of background. Did that for 10 years, had a lot of success, but there was always something missing. And come to find out it was being home. And came back to Marion 4 or 5 years ago, worked in Iowa City at a large regional bank, had a lot of success there. And fortunately, Kevin King and Ohnward Bank reached out to run their mortgage group. So here I am now.
Very cool, man. And you and I share that, and I think we talked a little bit about that, the first time that we had met, about sort of moving away from home, doing the corporate thing for a while, and then, having success and enjoying it, but realizing home was missing. That was sort of, when I was living in Utah, I was having really, by all measures, the time of my life out there, but it was like, man, it's more so it's the people, right? You miss the people back home. And so I definitely relate to that. So you've been doing mortgages and lending for quite a long time, have a lot of experience. What are your thoughts on the current environment?
I have never been in an environment like this. And I think, in fact, I don't think anyone has. If they have, they would be either lying or be too old to be in the industry anymore. So this is new, but I think the one thing that all my mortgage peeps would agree with is change is the only thing that's constant in our industry. So you roll with the punches, you understand what new normal is, and you adapt and adjust, and that's really where we're at right now.
What is new normal to you right now?
I think we're getting back to a more healthy place, and it sounds silly with rates going up, but when we're at 2.5-3% interest rates, what do you have to talk about, right? I mean, it's you want to buy a house, here's a 30-year fixed rate, take it or leave it, let's move on. And also the demand was at a place over the course of about 2 years there through COVID. It didn't warrant the necessary time to be, I think, a really good advisor for folks. And we saw our industry go through, that demand period where I think service lacked in general in our industry. I likened it to order taking, right? You go to McDonald's, you ask for a burger, they throw the burger together, throw your fries in a bag and hand it to you.
And that's not what lending should be.
Correct.
Because it's a much more involved thing than that.
Totally. And that's why I think we're getting to a healthier place now that I can really respect and appreciate. And, you've got to be able to counsel and advise somebody who, they're going to have to get creative with their financing. They're going to have to look at more options than just a 2.5% 30-year fixed mortgage. I mean, now we're talking a lot more about adjustable rates. We have over the last probably 6 or 7 months, just because it adds maybe some affordability. Lately, that's shifted back to 30-year fixed because, as we were talking a little bit before, oddly enough, we're seeing rates dip. We're in a great spot for interest rates on a 30-year fixed place right now. But then you're talking about down payment assistance and grant money. There's a lot of that's going around right now, which we'll continue to see. I think a lot more of those opportunities arise as when rates were low and demand was so high, you didn't really need to worry about if you're, I guess, the FHLBs of the world or the groups that are offering financial assistance, 2.5-3% interest rate with 100% financing available in market. Not a lot of people needed down payment assistance.
Right.
Right now, we're seeing some of the larger institutions that kind of lived by that 100% financing not offering that anymore. It's a risky thing to do, and with house values potentially. I don't think they'll dip or decrease, but remaining flat, kind of at best, it's not a really easy, healthy place to be offering 100% financing.
And I think you had a lot of institutions that were padding their asset books with low rate products, right? Which maybe it's great when it's an all-you-can-eat buffet, but then when economy gets a little tighter and rates get a little higher, well, maybe those, you're having a full book. because not a lot of people may understand this, but there's a fixed amount of assets and liabilities that you can have on, depending on your deposit ratio, your liquidity ratio. So if you fill that whole ratio up with low interest rate products, like maybe it was great at the time, but now you're really getting squeezed on margins for things when you have to offer a much higher deposit rate to keep deposits coming in, right?
Totally. I mean, I think what we're going to see in 2023 is going to be very interesting. And just to kind of the long and short of it would be we saw a lot of institutions work really fast and loose over the last few years. And they were on the all-you-can-eat buffet line. And people needed loans and they were supplying. That's part of their service and it's important. But sustainability in lending is super important because if I can lend like crazy over a 2-year period, but then I have to shut the faucet off for a year, what service am I providing, long term, right? So we saw a lot of peers in the industry, larger peers that got out in front of their skis and they were up at 130% loan to deposit ratio, which means that the customer deposits that they had, they were lending at 130% clip on top of that, which I would say, a healthy place for a bank to be is probably in the 95 tops, kind of 90, 95 range. So you're not overextending yourself. And as a result, we saw some of those folks stop lending on their books. And here we are now where that faucet is still shut off for a lot of them. And the scary place is now the transition from that is, well, what do you have to do? You either have to lessen the amount of loans you have on your books or you've got to increase deposit share. And the only way to increase deposit share right now is to really hike up the rate that you're giving out in yield. And talk about danger zone. If I'm full of loans that were issued at 3.5%, and now I have to then lend out or give out the yield of 4.5% on a CD or deposit account, my margins don't look very good.
Right.
I'm probably not doing very good long term.
Yeah. And, I think there was a lot of that. Obviously, there was a lot of that on a lot wider scale with a lot more reckless abandon in 2008. Like, we're not in the same place as we were in 2008, and the practices are much different. Underwriting is a lot different. Totally. You mentioned where you're starting to see more arms come in, which is interesting to me to hear you say because, when I was really sort of immersing myself in the market at the beginning of the year to really kind of reorient myself, there were almost none. In fact, in the Cedar Rapids market, as of even June, there was maybe even 3 arms done total, right? Yeah. Because the product wasn't needed when rates are at 2.5%. I think you mentioned this, but I want to dig on it a little bit. There's no bad instruments. There's bad intentions.
Sure.
Right? And so there's always a product exists because it fills a need, but that need can get, for lack of a better word, perverted or misused in inappropriate situations. So if you can't afford, a $400,000 house on a 300 or a 30-year mortgage with 5, 10, 20% down, well, then you certainly shouldn't go out and get it on a 10-1 because the rate is maybe makes it a little more affordable. And that's where a lot of people got in trouble in 2008 that was the default. Oh, hey, you can't afford it on this product. Let's just move to this one. Oh, shoot. Well, now your rate's all over the place. Or maybe there's a balloon you didn't understand about. And that's where a lot of people really got in trouble. I think some of that sort of Wild West sort of attitude has been reeled back a lot. The Dodd-Frank Act and the Volcker Act. There's a lot of things that got passed after 2008 that really helped sort of rein that in. And so you see those products out there, and I think they immediately get a bad rap of oh, you shouldn't get an ARM. Right. Well, that's not true, right? You should just understand what it is and where it's applicable and how it fits into your financial picture. Mm-hmm. Because for some people, it's great. For some people, it might absolutely be the right thing. You just have to understand what you're getting.
Right. 100%, yeah. And I think to circle back on the 2008, a good example would be, fortunately, we were insulated in the Midwest. I mean, for the most part, we didn't have a lot of the same practices that a California or Florida saw. We also didn't see the massive spike in home values that they saw, which also was followed by the massive decline. And a lot of that had to do when they were experiencing such a large increase in value year over year. it made it real easy to get loose with lending, because if
Sure.
you're going to gain 5 to 10% on your value every year, well, me giving you 100% or worse of a loan, I can absorb that.
Because there's going to be equity built in
Correct.
very quick. Yeah.
Yep.
Just to this point, and we'll come back to this,
Mm-hmm.
there's already people that maybe have bought in the nation, not necessarily in the U.S., that are seeing the other side where now they're on upside down.
Right.
That's something we haven't heard in a long time, right? Like, it's been a long time since that's really been a thing, because exactly what you're talking about. Home prices are rising so fast that it's like you could have bought it, and maybe it was even a little overpriced at the time, but it's just going to keep going up, so you're in a fine place. But
Yeah, I think the fortune that we've had, the legislation that we had, which the regulation in '08 and beyond, obviously being in the industry, it was a lot of heartache. And I think the unfortunate piece was it did run a lot of people out of the industry, because the compliance cost alone of managing mortgages is difficult. So that's kind of the bad byproduct. But the good byproduct of that is, you had to put 20% plus down to buy an investment home, right? Or you had to put at least 10% down to buy a second home. And why is that important? Well, if it's my primary home and I get a little bit underwater, or the value comes down and I'm in a little bit of an ugly spot, I still have to sleep somewhere. So it's not as easy for me to walk away from that.
Mm-hmm.
What we saw in '08 was these folks were way underwater on an investment home or whatever it may be. Well, I don't really need that investment home. I'd rather walk away on that investment than necessarily live with it. So the regulation we had in '08 was super crucial to what we're experiencing right now. And we're a far cry from where we were. And I really think that's why we're not going to have as extreme of an impact, especially in the Midwest, than we had then.
yes, and because of some of that underwriting and credit worthiness on the other side, making sure that buyers aren't sort of in that place where they're just like, heck with it, abandon it, see you later. My credit was already bad to begin with, and maybe I don't care, right?
Oh, yeah.
Do me a favor. Will you just move a little bit more in front of that?
This way?
That's perfect.
Good.
Thank you. So oddly enough, though, I've seen things about the auto industry has been doing just that in the since 2020, because they got sort of their eyes bigger than their stomach. Not in all cases, but maybe there was places, and that's a much less regulated space. Still regulated, but not like mortgages, right? And so there's maybe a little more room for bad actors or ill intent, if you will. And so it'll be interesting, as we went through this huge crunch of, people couldn't even get rental cars. They were getting moving vans as rental cars because it was cheaper, right? Because the squeeze on inventory was so big, because everybody was buying them, chip shorted, whatever. And then lending is like, heck with it. Vehicle values are going up. Just write whatever you can, get it on the books. As default rates, and this is just like in '08, right? As default rates hit for buyers that, maybe they bought. Did you know the average car payment, if you go back 5 years, average car payment was $400, $450, right? Now it's close to $700.
I can't even imagine. Yeah.
What does that even mean? Like, I read something like 30% of Americans now have a car payment that's more than $1,000 a month. One car, not multiple cars, one car.
Right.
That's not sustainable.
Right.
At a median income of this is where I was watching. I'm a huge nerd, and I always watch a lot of macroeconomic stuff at night in my free time. And somebody had brought up that we're starting to get into income limiting price values. Maybe actually Jerome Powell might have even said that during the meeting yesterday. And what that means is, like, there's only a certain affordability based on median income, right? If the median income of a location is $50,000, $60,000, the median home price cannot be $450,000. The calculations just don't add up.
Yeah, that was Powell. You're right.
Yeah, and so he mentioned that, and that's something that I mentioned earlier this year as something that I thought the Cedar Rapids market, because we're a pretty insulated market, right? You don't have the blended metropolitan areas where you can get a lot of people moving in and out. It's like if you're going to come to the Cedar Rapids market, you got to want to be here, sort of place. Yeah. And so home prices is going to be dictated a lot on what the median income is. And when we're seeing median income or median home values, and we still are sort of seeing median home values or sale prices, which dictate, because real estate's priced on the margins, right, was $230,000, $240,000, $250,000. Well, the median income of Cedar Rapids is only $60,000, maybe $65,000 if we're being a bit generous about wage increases. That's unsustainable. That home price is unsustainable. So where does it go? I mean, inventory's short, so prices are still going to be high.
Right.
When demand was high, they were still going up. But, if demand's coming down, we may see, I don't know, what are your thoughts? We may see prices come down more this go around than we did in 2008 because of the median wage, right?
Yeah, I'm cautiously optimistic. And the reason I'm optimistic is our demand, our supply is so low that it is, at least so far to this point, really kind of bolstered in that supply and demand space any type of issue that we've had with demand, right? For example, and the example I'll use, from a realtor space, right? If I'm listing a home and I get, it wasn't uncommon the day you put it up to get 20 offers on that thing. Well, that's a massive demand and supply deal, right? Now, let's say now I put that up, and I just looked the other day in November, year over year, there was only a 2-day increase to time on the market, which is a good sign, right? Because we're not necessarily seeing a massive spike in homes sitting on the market, not moving and that sort of thing. We're not there. And so that's a good indicator for us. But do I need 20 offers in order to continue to keep my value up? No. I probably need 2 or 3 to get in a race and compete for this house. And right now, I would say for every home, we've got at least 2 or 3 buyers still that are looking for that. And so that's why I'm cautiously optimistic. Based on the housing report in Marion that Medco put on, we're not out of the dark anytime soon with low inventory.
Right.
The demand's going to be there. And then when we see the downstream effects of rising interest rates, and again, if we're talking supply and demand, that also leads to rent, right?
Yep.
So if I've got normally a handful of renters for this property, and now we've got others that are now sitting on the fence, they don't want to buy a home because rates are higher. Well, I've got now 20 people vying for this rental unit. And my price goes up because my demand goes up and supply is still limited. So, that bleeds into the rental space. And I would argue that it's going to do that so much here. We're going to see enough of that it's going to inspire folks to still be on the market to buy a house, right? Nobody wants to pay rent that's even close to what a mortgage is to buy someone else's house for them. They want to be the ones that are contributing to that equity. And to be honest, that's one of the biggest gateways into wealth is buying and owning a home and gaining equity in that home. And I don't think that goes away. I don't think that demand goes away far enough for us to experience a huge drop in values. That's my optimistic piece. But, yeah.
I mean, it's certainly to be seen, right? It depends on the supply demand. You had mentioned, we're starting to see some more homes on market, and in fact, as I was pulling numbers earlier this week or late last week, we're back to around 1,100 homes on market, sort of at any given time, and earlier, July, we were around 400, 500 homes on market. So it's doubled, but 1,000 still is not maybe all that much. So days on market's creeping up a little bit, but we're seeing sort of this Goldilocks period of rates coming down and home values. 10 to 15% of homes on the market have had a price reduction throughout their tenure of the listing, which is another sort of leading indicator that maybe values are softening a little bit, maybe demand is softening, maybe some buyers are stepping out of market. But now, as a buyer, if I was a buyer a month ago and I saw 7% interest rates, now I'm looking anywhere between 5.5%, 6%, maybe even better. Yeah. And home values might be coming down 10 to 15% from some of the reductions that we've been seeing. Like all of a sudden now I'm buying as if it were January of this year instead of, November. Yeah. They're much, much different things.
Yeah. And I'm a big...
And, one thing, much less competition.
Sure. Yeah, no, you're right. And I'm a big believer in Fannie. They do a lot of forecasting, and they're actually projecting us to see interest rates remain flat or lower over the course of the next 2 years, which is astounding because
despite the Fed rate target being 5 to 5.25 next year?
Yeah, and I think the reason for that is when we saw, let's say 2 months ago, we peaked. I think we were all pushing at about 7% on the secondary market for 30-year fixed. So let's just use that number to be safe. 7% is where we were at. We're now down to 5 5/8 roughly. The reason for that is basically we are tied similarly to the 10-year Treasury, which is a futures market. And so if I'm an investor on a 10-year Treasury note, I'm not looking at what's happening right now. I'm looking and predicting what's going to happen in the future. It's a long-term deal. Yeah. And so when the Fed came out a couple months ago or 3 months ago, they were extremely clear that they were going to rack this baby up and they're going to tamp inflation.
sufficiently restrictive is the word that he likes to continue to use.
Yep. And so when they say that without a ton of clarity as to what that means, but they were pretty aggressive on the fact that they were going to go 0.75% every time that they meet until they tamp inflation. We didn't know what that meant.
Right.
That could have meant through next year,
yep,
for all we know. And inflation was at a place, we hadn't seen inflation like that before, which happens when we take action that we did over the of course, last year, cause and effect. But regardless, that 10-year Treasury note peaked at a time that the forecast was very grim with them increasing rates. The reason that we've seen it come down more aggressively is we started to see inflation get impacted in a appropriate way. We saw inflation tamp and come down. So the CPI, the Consumer Price Index, which is a good index to kind of see where we're at based on inflation, that was improving. And so Powell and the Fed comes out and says, things are looking a little bit more in line with what we were hoping to see. In fact, we're a little bit ahead of schedule, even if it's by 0.02%. It's improving faster than we expected. And then this last meeting yesterday, they raised it 0.5 instead of 0.75, which is when we saw rates come down. Gosh, this would have been 3 or 4 weeks ago to the levels that they're at right now. That was based on data that indicated inflation is being tamped faster than they thought. And people were basically betting that the Fed was going to not increase by 0.75, but tamp down to 0.5. We all kind of knew that it would be 0.5 a few weeks ago.
Yeah, and so this is something I mentioned on as I was talking with somebody else, is that the Fed, the market's leading the Fed, right? Mm-hmm. And I think that's just capitalism, because all investors want to get an edge in the market. Totally. And so if they can figure out what the Fed's going to do before the Fed does, then they can get an edge in the market. And so, naturally, I think as Fed should be setting monetary policy, it's really Wall Street that's like getting ahead. It's not that Wall Street's setting monetary policy, but they're figuring it out pretty good about where things are going to go. But I would say, that's all supposing that CPI continues to come down, which isn't necessarily all that obvious. I mean, you could sit there and say, hey, it's starting to come down, so here's how it should tick down over time. But, what happens when energy crisis hits this winter, or, the cost of oil doubles, or, maybe we can't get oil because we're capping the price of oil, which is weird that we're saying, they don't have to sell it to us at the price we're demanding. Right. There's a number of things that could upset sort of the road to recovery, if you will. So I see CPI numbers come back down, and I see the market reaction, and it's not all that obvious to me that it's going to continue to come down. Sure. In fact, there's use cases even in the late 80s or the early 80s where it came down for a bit and then spiked right back up, right? Sure. Which is kind of what everybody's worried about. And I think that's what, Jerome always says this phrase, history has issued a dire warning that we can't let off the gas pedal too soon. That's right. And I think that's exactly what he's referring to, right? So, I don't know. You can see it's interesting when you look at the yield inversion between the 10-year and the 2-year, and now the 1 year's inverted to the 2-year. You can sort of see this tidal wave effect of sort of when inflation should be over, if you will. Yep. And you can sort of time it, right? When it moves into the 1 year, it's like maybe, okay, we're 1 year back from being normal. When it moves into the 6 months, okay, maybe we're 6 months out from things being normal. Because as you mentioned, it's a futures market, and investors are kind of betting on where our interest rate's going to be after a while. So I think, certainly we're within that 12-month period, but that doesn't necessarily mean that the wave can't go back the other direction a little bit. Yep. So some of that's remaining to be seen. But
yeah, and I think that invert that you're talking about with the yield curve, that's also a massive precursor for recession. Mm-hmm. And that's Fannie has been very clearly predicting a recession of some sort, going into 2023. What's interesting is the definition of recession seems to change, because ultimately a recession is defined by GDP 2 consecutive quarters declining.
Was defined until the White House said, just kidding, it's not that anymore.
Until Q1 and Q2 of this year we declined, and then they didn't call it that. So it's going to be certainly interesting. I think, those that I talk with about this consistently, I feel like they're going to write books about this. I mean, we're in such an interesting time that it can be a case study for years to come. We're just living through it. And, obviously hindsight's always 20/20. So it'll be great looking back on this and saying we should or shouldn't have
We
done
should have
that.
done this.
Right. But I will say I give a lot of credit to the Fed. I give a lot of credit to Powell. As much heartache as this is with the increasing rates, the chickens had to come home to roost at some point.
Oh man, I'm so glad that's come up 3 times in the last 3 days. The chickens had to come home to
They
roost
did.
at some point. I had mentioned that in terms of the whole FTX scandal, but no, absolutely, you can't. And we were on. If you take out the COVID sort of drop and then bull again, like we were on a long bull run.
Oh yeah.
And it's got to contract at some point.
Yeah, and I don't know. I think everybody who follows along, as soon as we started with the handing out of money and PPP and everything that we did to try to avoid disaster, I think we could have called this coming.
Michael Burry called it very early in 2021, right?
Yeah. And so it's one of those things to where it's like, okay, not if, but when.
Yeah.
And I kind of like that the Fed's trying to control it the best they can. And again, it's causing a lot of heartache, but at the end of the day, they're going to the edge of where they can to get things back to where they need to be and try to avoid disaster.
Yeah.
And to your point, do we know what's going to happen? Who knows what's going to happen? We're a cataclysmic event away. One, whether that's, what's going on in Ukraine or there's a million different things going on right now that could spark disaster and put us right into a recession. Fortunately, we can't live by those because they could happen at any time. Right?
Yeah, you can't live like, hey, an asteroid's going to hit the Earth tomorrow,
Yep.
because what are you going to do?
Exactly. Yeah.
I see you brought some materials. What did you bring?
These are just little notes that I have. I'm also a nerd, and I'm a big follower of Fannie Mae. They've won awards in the past just because their forecasts from 2020 and 2021, which, again, why that's so important, we were at an unprecedented time. And their forecasts they won awards for accuracy. And so they pay millions of dollars for research, and they pay millions of dollars for forecasts, and I can click a button and get them all, which is great.
Yeah.
And so I would encourage anyone listening, if they're looking for this stuff, if you Google Fannie Mae forecast, they have a housing forecast and an economic forecast. A lot of great dialogue that can come out of that are leading indicators, and they're also getting into 2024, which good luck with 2024.
Yeah,
I mean, who's really predicting that? But at the same time, at least gives us something to consider as we game plan for what the future holds.
So if I'm a buyer today, how should I be thinking about the market and positioning myself? Is now the right time to buy? I hear a lot of people saying, well, maybe I should wait for rates to come down. And, to some credit, rates have come down further than I expected that they would bounce off that 7.
Yeah.
I was a little more pessimistic, thinking they'd hover around 6.5, 7, or maybe even a bit higher as we got into these additional rate increases. But, is it a good time to buy a house? Yeah,
good question. I think we're giving the rate too much power in that decision.
I agree, actually.
And alongside that question, everybody's different, right? If I had a younger brother who was living with my parents rent-free and was wondering, should I buy a house right now? Maybe not. If I had a younger brother who was renting and paying right now what's realistic, $1,000, $1,200 in rent, and they're starting a young family and wanting more space to start to begin to grow wealth and build equity in a home, and he had some funds available or even down payment assistance available, of course he should make that move. So it really does depend on the person, and that's why when we were talking earlier about everyone had a certain amount of bandwidth, and in 2020 and 2021, when everybody was buying or refinancing, bandwidth wasn't there.
Yeah.
The consultation wasn't as in depth in a lot of cases, which is unfortunate. And, we're seeing that now with folks that, maybe got into 100% financing and the values are coming down, right? And so maybe they didn't know about that grant fund that's available, or their lender didn't take the time with them to talk through the programs that are out there through the government with USDA or FHA or, whatever else there might be. But everyone's circumstances are different. I just want to make sure that, in my opinion, we can't give so much power to the rate. The age-old expression, which we've heard before, date the rate, marry the home. You can buy your house at 18% interest like our parents,
some people did.
Our parents did in the 80s, right? And it doesn't mean that you're at 18% in 2020, right? I mean, you refinance that thing, or you take advantage of low rates when they come along.
Surprisingly enough, some people are refinancing already, even after buying their home in the middle of this year, because rates have come down a point or a point, or a percent or a percent and a half in some cases, depending on where you bought your house, and that's a substantial amount. So if I bought, what about I bought my house in in September and I had a 6.25% interest rate, is it worth it to refinance for 5 5/8?
It depends. We're very blessed in Iowa. We're a very low-cost fee state, and those that haven't worked outside of Iowa or are familiar with fees outside of Iowa, it's a wide range of what people get charged when they're doing a mortgage. In Iowa, consistently across the board, and I can say this because we're all very similar, but it's ballpark $2,000. That's the cost, and that includes everything: title, appraisal. You might have a lender that's out there charging more. Very rarely can they charge less because most of that's third-party fees, just to basically pay your attorneys and that sort of thing. So we're very fortunate with low cost, and the reason that's important is the time it takes you to recoup that is very small. So, for example, in your scenario, loan amount matters because let's say I've got a $300,000 mortgage and I go from, you said maybe 6 1/8 to 5 1/2 or whatever it may be. Well, if that payment difference or the interest difference that I'm paying on that's a couple $100, well, in 10 months, I'm recouping the fees that I paid to refinance, and I'm moving ahead from there with a lower payment. And then a good advisor would also take you through, okay, yes, you're decreasing the payment by X, but if that fits in your budget and you make the same payment as what you're used to and comfortable with, well, then you get this home paid off 7 years sooner and for $80,000 less in interest. And those are the conversations that have to start happening again, frankly, with these individuals.
I'm such a big proponent of financial education, and I feel like there's two things that are very unfortunate from a personal perspective for a lot of Americans, which is our relationship with food is often broken and our relationship with money is often broken. And they're broken sort of by the same thing, in that a lot of people think a diet means I can't eat, and a lot of people think a budget means I can't spend. And those two things do not mean those things at all.
Totally.
And so, we don't have real good public education around financial education. I mean, I'm not saying our public education system is bad.
Yeah.
I'm saying we don't spend a lot of time educating, children, teenagers, whatever, high school, college kids. Like, what is a personal budget? What is a finance? What does it mean to get a mortgage and these sort of things? And so I agree, financial education is so important and it's so powerful. It doesn't take that much effort or knowledge to really start to dramatically change your personal financial situation just by some of these things, right? Mm-hmm. Hey, and sometimes it's just having somebody else help you look at it that knows what they're talking about. Because somebody might be like, 6 1/4 down to 5 5/8. I'm not paying $2,000 to refinance that. And you're like, well, actually, that's if you're saving $200-300 a month, sure, it's going to take you 10 months to pay it off, but that's now $300 a month. You want to put that on a credit, maybe now you're paying down a credit card and you got that credit card paid down. Maybe that minimum payment was $100. So now it becomes $400 a month, right? There's so much power in and this is, I think, why you were talking about don't give the rate so much credit, because it's such a powerful instrument to give you a lot of options you didn't have before as a renter.
Totally. Yeah, no, I agree. And there was nothing more frustrating. This would have been 12, 13 years ago. Big refi boom in like the 2009, 2010. HARP refinance was a big deal back then. Nothing more frustrating than when it would be the rhetoric or the conversation would be, well, if you're not lowering your rate a full percent, it's not worth it for you. And nothing could be more untrue, because that customer with an $800,000 mortgage, that interest rate of 1/8 is going to save them more, an 1/8 drop is more money that a $100,000 mortgage will save with a full percent. And so it's all relative.
Exactly.
And the more customized an approach can be, the better. And I just think we were living in such a cookie cutter world for the last 2 years. We've got it. That's where we've got to get back to treating everyone in their own circumstances.
Yeah. And for those of you listening, that is the most true thing, is everybody's scenario is different. And so just because your dad or your friend or whoever else says, I'm not going to do this because it doesn't make sense for me, it doesn't mean it doesn't make sense for you, because your situation is inherently different. And the best way to know is just ask the question, right? It doesn't mean you have to do anything, but asking the question, because maybe it is, and maybe there's some things that you didn't know that you had access to. One of the things I think is so blatantly obvious to a lot of people that have been in the game for a long time, but some people didn't know, hey, when house prices are going crazy, you don't got to sell your house to get the equity in it.
Right.
Just get it reappraised, get a HELOC, as long as it makes sense for you. And that way, if you want access to the equity, it's right there. You don't got to sell your house to get the equity. But so many people just didn't even consider, oh, I should just take advantage. That's the best thing about owning a house. When home values are going nuts, you can capitalize on the equity boom, by getting access to that equity. Or when rates are terrible or really good, 2-3%, you can refinance and lock in a lower rate even. Right. You get the best of both worlds when you own a house. It's back to the point of don't worry. Yes, the rate's high. Yes, it means you're paying more in interest that you're not going to get back. But eventually you can refi. Eventually, you'll be able to take advantage of the equity. Like Warren Buffett's famous for just saying, hey, just put yourself in the market. Doesn't matter when. Right. You're going to be better over time for having done so.
Same. So with owning a house, right? We talk about, values may be declining slightly or whatever it may be. If you look at the curve over the last however many years, it's going up and to the right consistently. And there may be a 6-month period or a year period where that dips. Well, how many people over the course of history have timed it perfectly to where they've bought at the very bottom of the market and then rode that thing up? It doesn't happen very often. And so those that say, well, I'm going to sit on the fence until it's the right time, none of us know when the right time is.
You're going to sit on the fence your whole life.
100%. No one knows the exact right time. And so that's a kind of a farce too of, let's play the market. I don't know very many that do a very good job of that. At all. So, and the other piece, to go back a little bit to the financial education piece, part of that broken, which, by the way, I've never had a bad relationship with food. I've always had a phenomenal relationship with food.
It's delicious, and I love it. I love.
You don't get this frame without loving food. However, from a financial perspective, part of that issue is I know that there's institutions, banks, credit unions all across the board. We're the most overbanked communities anywhere in Iowa, and to be honest, we're so overbanked, and by overbanked, I just mean there's so many options in the financial services world here that the big boys don't even play. We don't have the Wells Fargo's, U.S. banks, the big box companies, because the margins are so compressed here by competition. They'll make more on one deal in Minneapolis than they'll make on 5 deals here. And so they don't want to play this game. And that's a good thing, because if you want to talk cookie cutter, go to a Wells Fargo, right? I mean, that's why they got to where they are, is they stamp it, right?
Well, you have to, a certain scale requires certain rigidity in terms of...
Exactly. Yeah. Exactly. And so we have such an opportunity in Iowa that I know plenty of bankers in our community that would love to get into the schools and just teach kids about it. In fact, Sandy Ikeda, who's our private banker at Ohnward, her and I are going to Marion Independent School District teaching 3rd and 4th graders. And what do you teach a 3rd and 4th grader, right? We're not teaching them the Law 72.
Yeah.
We're teaching 3rd and 4th graders about comfortability with saving money and comfortability with a bank. Because at the end of the day, if I've never seen anything from a financial services perspective growing up, or maybe I'm from a background or in a community to where that's not something that I've had access to or privy to, well, am I really going to feel comfortable at 22, graduating college, going in and sitting across from a guy with a tie on who I don't know? It's a stranger?
Right.
Probably not.
Right.
But if I grew up in an environment where I was comfortable around those people, they spoke to my classroom, I respected what they had to say, they were teaching me something of value, well, then I'm excited to talk to that person as I get older.
And by the way, you're primed throughout your entire life from, a lot of media and other just people's personal takes, like, oh, those damn evil bankers, they just want to take your money. It's like, I'm biased because I worked in banking, but I've seen behind the scenes in banking, and I can honestly say I've never heard somebody be like, oh, we're going to do this because it's going to screw that person out of money. Like, I've always been blown away at the amount of just morality that people address it with. Like, hey, no, we're not going to do that because it's not right for the consumer to do. Part of that's, it's been beat into the heads by regulators for so long. But it's like, if you're primed with that your whole life about, oh, these evil bankers are just trying to sell you stuff and take your money, well, then, how are you going to feel? You haven't had any education on it, and you think this person's there as your enemy.
Right. Yeah. The bad apple always spoils the bunch, right? And the one thing I will say, and it's an advocacy for local community banking, our community banks are only as good as their communities. And the more that our communities flourish, both individually and commercially, the better the bank. And so I'm a big advocate for community banks and community banking. If you can go to the guy whose kids go to your school and do a mortgage, that means something. That's a lot different than maybe calling an 800 number and, them, again, cookie cutting something out for you. That's where the big bad banks come into play, because I treat, Joe A.
You got to see the people you're lending to.
Right.
Yeah.
I'm treating him the same way I'm treating somebody, so that this $1 million customer that has a ton of assets in the bank, well, that customer who has a perfect credit score and does a really great job, if I'm big box bank, I'm giving him more attention than I'm giving the guy down the street that's, a blue collar worker. That doesn't happen with community banks. These are neighbors, and these are folks that come in and you treat them all the same, because again, this is our community. This is where we live. So that's one blessing we have in the state of Iowa, is that we are overbanked. But we're overbanked typically especially when you look at the small towns in our area, and I would consider Cedar Rapids and Marion to still be a small town. We have a ton of local community banks that are based here, doing business here, that are only as good as the success in the community.
Yeah. And I would say, sort of what you're touching on also is find a personal relationship with a banker, a lender, just somebody that you can talk to about these things, that can get to know you and your situation over time, because personalized information is even better. If you call a national bank and you get sort of a faceless whatever, they're still going to get you in the right direction, but somebody can be intimate about your situation, and you can call and be like, hey, Travis, I'm thinking about this. Totally. What do you think?
Yep.
You're going to give them a thought, and you're going to be like, well, hey, I know that you've been working to save for a down payment for a house. Do you really think buying a car right now is the right thing to do? Right. And just have it. And it's not that you're going to, control somebody, but be able to build that personal relationship. It's one thing that I've been at my bank since I was 16. So, more than half of my life. And it's great. I like it.
Yeah, well, to circle the wagons again on the financial education piece and getting people comfortable with that, there's a lot of individuals, a lot of families that they don't have that access. There's a lot of families that have that mindset of the big bad banks, right? And typically that stems from either a lack of, I guess, a relationship that's been built, right? Or they've had an experience in the past that was unfavorable. Well, if you look at the history of this country, I think there was systemic racism and issues that came into play with banking that I think since has been improved as it should. And there's been improvement in a lot of spaces with that. However, I think that stigma sticks.
Yeah.
And if
feelings take a long time, right? Well, like that experience takes a long time, and it's not so easily overwritten.
Right. Yeah. I think this is a much deeper subject, but at the same time, it's so important for us to really bank the underbanked. And the underbanked are those that don't feel comfortable going into a bank and having a conversation, maybe because they've heard no before. Yeah. And that happens a lot. And the only problem that we have, and we're going full circle here, kind of, but cookie cutter style, 2 years of 2020, 2021, when folks are drinking through a fire hose, it's yes or no. I want to buy a house. Can I buy a house? Yes or no. Right. And there's no let's really exhaust all options. Let me help you create a plan. And it's not a no, it's a not right now. And then I'm going to put a calendar reminder
or
out.
Not that way.
Yeah, that's right. Right. And let me put a calendar reminder out in 3 months, do A, B, and C. Let's get back together in 3 months and see where we sit. That's a good consultation.
I think this is a good point, because I've been having these sort of conversations with a lot of lenders, and I think this is, just what you said. People are expecting a yes or a no. And when they hear no, they think, well, shoot, I guess I just can't buy a house. And it's like, no, that's not, that nothing could be further from the truth. And in fact, that lender's the perfect person to tell you how it can happen.
Totally.
No just means, here's what we're going to have to do before you can. But we can help you get there.
Right.
Maybe your credit's not enough. Maybe you don't have a credit profile. Maybe you got to start with a credit card and start working on that. Maybe you got to pay some credit cards down because your credit utilization is too high. Maybe you got some derogatory marks on your credit statement that you need to work on. But it doesn't mean no forever. And by the way, if you're a buyer and you hear no from a lender, if it's a hard no, find a new lender. Because they should be telling you,
100%.
Here's how we can get you there. And to the lenders that I've been talking to credit, every single one of them has always said, here's how we can get you there.
That's right. Yeah. I mean, it's what other job do we have, right? That's why I say order taking, and there are not great mortgage professionals out there.
Sure.
I mean,
just like everything.
Just like there's not great everybody anywhere, right?
Yep.
And so there are folks that it's a hard yes or no, or it's a, hey, I'm busy, and so if you qualify, let's talk. If you don't, go down the street, right? That's the problem. And so you're right. I implore anybody who's dealing with that or has been told no, well, it can't be no. It's got to be here's why, and here's what's in your future and what it can hold. And that to me is the difference between a professional and, I guess whatever else you'd call that other person.
Yeah, it's certainly the difference between somebody that's taking a long-term approach to relationship banking or somebody that's working so short-sighted because it's like, oh, I'm going to be able to eat forever, so I don't need to build a relationship. Well, that's not sort of how it works.
That's right.
And as you mentioned, us being in a small community and having so many community banks that aren't just the order takers or the cookie cutters, there's a lot of relationship building out there.
It's beautiful. I mean, that's what the beauty of it is options. And if I don't treat that customer with the right type of respect, the right education, the right guidance, and I don't truly care for that customer, there's 50 of me out there.
Yeah.
And I think those that are probably more surface level or transactional and not relationship driven, which there's plenty out there like we talked about, those are the ones that probably are chewing and churning all the business and tossing these people to the side. And as a result, what do we have? We've got a bad reputation on bankers. And that person that was told no by banker A, who was a jerk and didn't really care for their future or anything else, well, now they're all the same to me.
Yeah.
And I think that's the greatest thing about competition. That's the best thing about capitalism.
Yeah.
Someone can go down the road and talk to somebody else and have that conversation if they're not getting the right answer out of who they have it from.
And the other thing that I've learned to love is I've not met a non-nerdy lender in like the best way. And what I mean by that is every time is, I'll say you guys like lenders have always been very eager to talk about stuff. It's not just like, hey, I don't want to talk about this. It's like, no, hey, finally somebody wants to talk about it. Like, well, let's talk about it. And so, if you're not getting that sort of eagerness or somebody that's willing to sit down and have the conversation, look for somebody that is, because there's a lot of them out there like yourself that are.
Yeah. I mean, same thing with, let's say it's a realtor, right? I think my analogy would be a dartboard, right? If when we were drinking through a fire hose 2020 and 2021, I didn't ask many questions if I was a bad lender, right? Because I didn't have to. And so then I would kind of close my eyes and throw a dart at a dartboard, and maybe I hit the bullseye with what your needs were. Probably didn't, though.
Yep.
So I got you into something that was good, but it doesn't necessarily pertain to you specifically. Whereas if I can take my time to ask the right questions and know where that bullseye's at, well, then I'm setting you up with something specific and custom to you. I think a really good example that I actually just closed on Tuesday, and I think this is a really good story to tell because it's so important to what we've been talking about. But we had a customer who's a first-time home buyer. He's got 3 young kids under the age of 4. So they're 3 years old. Yeah, I felt so bad for that alone, right? No, I've got 3 boys.
You'll get some sleep in a couple of years.
Yeah, I've got 3 boys, 11, 9, and 6. So I can relate. But, they were initially pre-approved by one of our larger lenders in town for a USDA loan. USDA is 100% financing. And unfortunately, there's not a ton of 100% financing out there. They did not have a lot of money to put down. They were pre-approved and told that was the only thing they could do, was 100% financing through a USDA loan. So they ended up getting turned down by this lender. And so they kept going lender to lender. I was the 10th person they talked to.
Dang.
So they went through 9 credit pulls, mind you.
Oh, yeah.
Oh, yeah. So by the time...
That gives me heartburn alone.
Oh, boy. And they were all of the lenders were only looking at what the customer was telling them they were looking for. They said, hey, I was told that I can get a USDA loan. I want to do that.
Oh, man.
Oh, yeah. So just
they were taking them at their word. And then,
right?
Man, yeah.
Right, which is okay, right? If that's what you want, let's talk about what you want, but let's talk about why you want it, and there might be something different.
Yeah,
okay?
absolutely.
Right. So I'm 10th person to get the application, and we're talking through everything, and the need is very obvious. They don't have a lot of money to put down, but they need a bigger space for a family of 5, right?
Sure.
So the need was pretty clear. That being said, if they don't have a lot of money, not one person even looked into Federal Home Loan Bank has a $7,500 grant. No one even looked into that. It's income qualifying. So if you're under a certain income level, median income level, it's 80% of the area median income, which in Cedar Rapids, I believe, is somewhere around 75,000. If they fit under that for the household income, they qualify, in most cases as a first-time home buyer for that grant. In 45 days from when they talked to me, we had a $7,500 grant. We talked about how important seller credits are for someone like that. Let's get some seller credits to take care of your taxes and insurance and your closing fees and that sort of thing. We closed on Tuesday, and he didn't pay a dime to move into the house.
Awesome.
And he was at like 95, 96% loan to value, right? So instead of him being at basically 100% loan to value, him owning technically no equity in that house.
Yeah.
And over the course of 2 years, because obviously interest is fairly front loaded on long-term debt, he would have gained maybe 2% equity over the course of 5 years. At the end of our 5-year stretch, he's going to have like 7 or 8% equity. And he's actually going to be able to use a realtor if he wants to sell the house. Because that's the other thing we're looking at right now is those that kind of lived and died by that 100% financing, we're kind of shooting the market in the foot a little bit because if you know this, because that's a big target for realtors in our market is FSBOs, for sale by owner homes. Well, a lot of people are turning to FSBOs because they don't have money for a realtor. They don't have equity to put into someone actually doing a good job of selling their home. The value of a realtor is massive. We've seen it. I mean, it's massive.
And just because you touched on that, one of the common misconceptions I think that realtors get is, hey, you're here to find me a house and that's it. And I can do that on my own, or I can sell my house on my own and save, a bunch more money. But that's not the value of a realtor. And I think even a lot of realtors get that wrong.
Right. Ask a mortgage professional the difference between working with a customer who's being represented and working with an agent or not. It's night and day.
And that's the, a realtor is a fiduciary. And what that means is I'm here to help protect your financial interest. I'm not here to necessarily just find you a house and say, good luck, hope you make it.
Right.
It's all just like the value of a lender is coaching and consultation. The value of a realtor is coaching and consultation and helping you protect your interests that you don't know you need. And that's where I think, if you are savvy enough to do for sale by owner, maybe it's a good product. Again, it's a product. It has its use case. But that doesn't mean it's great for everybody, because maybe you're not that savvy at it, or maybe you think you're more savvy, the Dunning-Kruger effect. Maybe you think you're more savvy than you are at it. Right. There's a lot of things at stake when you're going through a real estate transaction. It is one of the most complex transactions that you will ever do in your life.
It's the biggest investment in most people's lives.
Biggest investment, but also the most complex, from legal and all these other sort of liability things, right? And that's where the value of a realtor is. So if you're looking, should I sell for sale by owner, or should I buying for sale by owner is equally as risky as selling for sale by owner. And that's because you're missing that consulting partner in a realtor that can help guide you through the things, or say, hey, talk to Travis about seller credits, or, we're getting back to the first of the year when a lot of first-time homebuyer pools kind of re-up. Yep. And so hey, what first-time homebuyer credits are out there? And maybe your realtor doesn't know exactly all of them, but can connect you to the right person that will, and then help guide you through the rest of the transaction. So if you're listening to this as a for sale by owner, or thinking about for sale by owner, really consider that piece of who's in my court to help ensure my interests are being cared for.
Right. 100%. Yeah. No, without a doubt. Yeah, and I think the other piece of that too, just getting back to the financing side of things, that customer that I'm referencing, of the equity that they're able to gain, if you think about what he went into that initially expecting, right? Expecting to be at 100% financing, he still wanted to buy the house. New rates were at 7% at the time. Still wanted to get in the house. He knew what he needed. His goal was to get in that house and get away from renting, which he'd been doing, growing family, that sort of thing. He truly had the philosophy that we talk about of like own the home, date the rate. He didn't necessarily worry about a rate. He worried about a payment and fitting into that, right? You go down the road here now and we get him set up, and he was able to access $10,500 of free money. I mean, the $7,500 grant with FHLB and then the $3,000 of seller credits without proper guidance or representation. Does he know that? Does he achieve that? Does he even go down that road? Probably not. In fact, he didn't with 9 other lenders, right? And so
and not only did he not know that, 9 other lenders didn't know that.
Exactly.
Or at least think about it.
Yeah, right. And that's to our point of, if you're not getting the answer you want, don't quit, don't stop. There's other folks to consult you that are out there. And again, if you're getting a hard no, it's not right. It's never a hard no. It's always a not right now. Let's get you there.
I think some people can get frustrated having somebody ask them a lot of questions. But you have to understand, the person that's asking you questions is the person that cares about what's going to happen. The person that doesn't ask you any questions, maybe they don't care so much.
Right.
So that's a good barometer or gut check to say, is this person really here for me?
Right. Yeah. And I think that's also part of that relationship piece too, right? So your comfortability with that person, it does matter. There's plenty of customers that are probably fantastic customers that I don't necessarily need to do business with. That we don't gel the right way, and perhaps they're better off served by someone else. I'm okay with that, and we all should be okay with that, right? And vice versa, the other way around is if you are a consumer, you have the power to choose, and that's so important. Find that person that you trust. Find that person that if you buy a home and you use someone as your mortgage professional and you don't use them again, hopefully you find someone better.
Yeah.
Right? And that's the difference.
That's a crazy statistic to me, too. I don't know what it is off the top of my head, but I can feel that it's pretty substantial about the number of people that don't reuse the same realtor or the same lender.
Right.
And if that's the case, you have to ask yourself, why? Because once you find a good realtor, you can make that relationship with somebody. Once you find a good lender, you can make that relationship with somebody. And then it should just be that's the person you're calling back, not because of necessarily loyalty or, a popularity game or anything else, but because you found real value in that person. And you're like, hey, this person was great.
I think that's why what we're going to experience in 2023 is a little bit of a cleansing.
Sure.
In our market in a way,
the
right?
purge.
Yeah, in a way, right? And the reason that's okay is we had a lot of hobby lenders come into play when it was really easy to sit at the buffet line and eat. So if I can do refinance and drop your interest rate 2% and sign on with a bank that's just getting an influx of volume, well, that's really easy for me. I haven't met a lot of long-term lenders that have been doing this a long time that are scared right now. The ones that are real nervous right now are the ones that
came in 2020 or 2021 and they don't know anything different.
Their business isn't built off of referrals, family, friends, repeat business, right? Yeah. Those that have built their business that way because they doubled down on service, they're not concerned right now. Yeah, it's going to be slower, but those that have been in this industry long enough, we've been in this environment before where it's like, okay, what's this market going to be like? And it's going to slow down. Okay, is that a good or bad thing? Well, it's kind of a good thing because now I can actually take the time that I need to do a better job for my customers, right? So any market, there's wins and losses, there's good and bad. I think those that have been doing this long enough can look at this next year as an opportunity as opposed to, oh no, I better jump to another institution or find something else to do.
If you're positioned right, downturns can be great.
Sure.
Right? There's always opportunity in chaos as long as you've prepped and put yourself in the right position to take advantage of it.
Right.
But for the people that haven't, the people that haven't been planning or haven't been looking forward or have been short-sighted or, have, to your point, been building a shallow business, let's say, shallow business model.
Very transactional, yep.
Then you are scared. Yeah. And there's a reason for that.
Good riddance. I mean, that's it's okay, and that's the benefit of, I think, coming out into this, I guess, market that we're getting into is those hobbyists are going to leave, and not that we don't welcome everyone in the industry. Great, if you're really good at it, you're not leaving, right? Yeah. And so that's the same with realtors. I mean, that slice of that pie is really big. And it was really, really big 2 years ago, especially as it pertains to mortgage. It was a really big pie. And so even if you got a small sliver of that pie, you were eating really good.
Yep.
That pie is going to shrink. And if I'm only getting my little slice of that pie, then I'm probably not going to eat very good.
Yeah.
And I'm probably going to have to find another place to eat, right?
Yep.
And again, the reason that's okay is you should have been building your business in a way to expand your slice of pie because you're gaining influence and you're gaining customers off of your customers and you're doing a good enough job that you're warranting more business. Those that didn't earn trouble.
Well, and if I go to a real philosophical level here, this is something that I truly believe is if you were meant to do that or you were you truly enjoyed doing that, that's what you would have done. Yep. It's the people that maybe aren't committed to it or maybe they were just doing it to get a paycheck, whatever. And that's okay. Move on. Find your passion. Right. Not everybody's meant to be a lender. Not everybody's meant to be a realtor. Not everybody's meant to be, whatever. Find something that you are passionate about and that you can build that deep business in. So yeah, maybe if maybe there were some hobby lenders that are no longer going to be lending, and that's okay. Like it's good for them, it's good for the market, it's good for it's good all around depending on how you look at it. And for me, it's like, hey, go find your passion. Go find the thing you can go deep on.
Yeah, I pray you find something that you stick with because you care about it, right?
So time check here. We just crossed over an hour.
That's fast.
Yeah, I know, man. I told you it goes quick. And sometimes I feel bad because I feel like it's such a dry subject. I love it. I love talking about this stuff.
Some
I know
nerds are out there listening and loving
some guys like, I love this.
Yeah.
99 people are like, this is boring. Move on. No, it's good though. Travis, where can people find you?
You can go to onwardbank.bank, OHNWARD bank.bank. Bank's a new deal they got going on. Or you can find me on any social media. You can find me on there, Travis Eagle, EAGLE, just like the bird.
Just the bird of freedom.
That's right.
And we'll put all of his information down in the comments section like we typically do. Travis, I wanted to thank you for coming on, man. Great conversation. And, I'm glad you moved back into the market.
Yeah.
We've been able to connect. So, we'll see where things go, how things shape up. Thank you, everybody, for tuning in. I appreciate you guys continuing to give us support and tune into these things. And we will see you guys next time. Take care.